Hi, everybody, and welcome back. Thanks for joining us for the Mortgage Minute. It is Tuesday, and we're going to get right to it. Rates today obviously are holding steady, but they have gone up in the past week, 10 days, as everybody knows. But let's go through some cursory information about that now. 3.66 for the 30-year, 2.92 for the 15, 3.33 for FHA, 3.31 for the jumbo, and 3.60 for the 5/1 ARM. The 10-year is been up and down from about 1.7 to about 1.85 for the past week, 10 days. And today it stands at 1.78, the 10-year yield. The yields are rising. Everybody knows that, and they're rising as a result of the Fed tapering and the other things going on at the Federal Open Market Committee meeting, which is being held today, Tuesday, and tomorrow. We should get some statement from the Fed Chairman Jerome Powell tomorrow. A lot of Fed turnover in the last year, so I'm not quite sure where we're going to stand when it comes to dovishness or hawkishness. We're currently in a hawkish, which means that they're trying to tame inflation. The inflation, obviously, at 7% is untenable for most American consumers, although if you look around the world, there are some unbelievable inflation rates going on in countries in Central Africa, in the Far East, as well as in South America. To the tune of 15 to 20% or more. So our 7% seems high here because we're just not used to it. There's a couple of great articles on Housing Wire about that, about how a lot of the people who are in the regulatory agencies, even the Fed itself, have never been through a high inflation cycle, which is what we had in the 80s. Now, we had a slight high inflation cycle back in 2010, 2011, but the article even said that even that far back, or that little far back, as it only is 10, 12 years ago, there aren't many regulators who are around or who were around when that happened. So they just haven't been through this cycle before, and they're not quite sure how that's going to affect policymaking. But we are in a tightening cycle, as everyone knows. Let's see. A couple other things. Property rises in the top 20 markets. Right. Okay, here we go. The top 20 markets are up about 20%. The top three markets, Phoenix up 32%, Tampa up 29%, and Miami up 26.6%. That's year over year, December to December. Unbelievable, really high, can't sustain it. So if you're out there and you're looking for a house, don't be discouraged. The prices will come down, but it's going to take some time. We need more inventory, obviously, and we need a bit of tightening by the Fed, which will obviously quell the ability of borrowers to borrow money, interest rates going up, and the Fed sucking the money out of the market by way of this tightening phase that they're going into. Should slow the market and cool prices, but it's going to take 6 to 8 months to do that. That's usually and normally how it works that way, unless, of course, there's a bubble, which I don't see one, but there are some asset issues, and I want to talk about that right now. Okay, so the great article, here it is from Reuters. Today's central bankers have the unenviable task of weaning a pandemic hit global economy off cheap money amid unprecedented sovereign debt levels, with asset prices inflated by years of stimulus and near zero interest rates. That is a heck of a sentence, because it really encapsulates what's going on now, right now. And if you notice in that statement, there is no, I'm going to blame this, I'm going to blame that. This is a long-term issue that is yet to be addressed, and I talked about it a little bit by the few people in regulatory who have been around since the 80s, who know what inflation cycles are like and why they are what they are and when they are. But this is about an issue of long-term low interest rates and how people get used to something and think that's the norm. It's not the norm. We are into an inflation, non-inflation cycle. And right now we're in an upcycle. The Fed is going to try to quell that, which I think they will. It's going to take some time. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks very much for listening to the Mortgage Minute, and we'll see you next time.